Hey everyone, my name is Addy, and I'm a new user on Reddit. Um, I have almost 7 8 years of experience shorting option premium and doing it successfully. So this time around, I just decided to post some videos, some insight about the rationale, the thought process behind my trading strategy, and how I take a position and whatnot. Um, so I recently put a 30-year bond trade. And I normally trade in the futures options market so far, because I have a day job and I'm not really allowed to like trade other stuff yet. Um, so I trade futures which do not have a pattern day trading rule, and futures. Outright futures are very big for my account, so I trade options on those futures. My skill set is on the short option side. All kinds of strategies, credit spreads, strangles. Those are my favorite ones. Debit spreads on the debit side. Like the crux is, I have to be long theta, meaning I do not want to lose money on a daily basis on the time decay aspect of these options. So the trades are basically short ball, sometimes long ball, long theta, but always long theta. Here's a trade that I put on. Anyway, what's on my screen? It's a chart. The ZB chart slash ZB is a ticker. It's a 1 year chart. I normally look at 1 year, daily 1 years. I don't go too far out unless I do really want to check the trend. I will change this daily series to a. I'll still keep it daily, but I'll go out to I'll do a time frame myself, like a 3 year time frame on a daily basis. Anyway, what else I have? I don't really look at technical indicators. I'm a contrarian trader, meaning I go against the market. It's a risk reversal strategy, and I've been doing this successfully for a couple of years now. What I have here is I don't is something that I don't use. None of these arrows are part of my trading setup, but they're just there for my visuals. And this is just a recent addition on my chart. This line and the SMA line, and I keep it at 30 days because my positions are 30 to 45 to 60 days out to 50 days out. And it's basically to collect premium and then sit on those trades and then manage them if they get tested. And if they don't, then close the trade out at 40 to 50% profit of the max premium that was collected. Anyway, the video is already 3 minutes almost, so I don't want to take too much of your time. But here's the trade setup. The trade that I put on is 27 days out this time around because the next series was 62. Now this is too far for me. February 2024 is too far for me. This monthly one, 27 days out, is the one that's available. So I just took that. I don't normally do 27 days. It's a little bit too short of a time frame, but this is because the markets are calm and the rates decisions by the Fed had almost been done. So here's the trade. Now, also a couple of the things that I look at. Look at this open interest column here. These are thousands of contracts. This is something really important for traders like us on the retail side because this shows the liquidity in these strikes and in this product. Look, there are like 5,000 contracts traded. Now, I'll do a different video of the open interest and volume and how it works and what it is. But the bigger these numbers are, the better. The volume side, also keep an eye on the volume side. Also, the further out you go on the deltas, meaning anything lower than, let's say, 5 deltas here. So a strike of 108 on the 30-year ZB bond is basically very small volume. Open interest, yes, but volume, people don't trade this, or they haven't traded this recently. This is daily volume, meaning this is how many contracts were traded on Friday, and I think I put this on Friday. Anyway, the idea is this: the rate hiking is done, at least according to my understanding. It's done for the year, for the next couple of months, and then the ZB bond got hit the most because the rates went up from basically 0 to like 5, 5.5, whatever that Fed funds rate is right now. And then these are the bonds that get hit the most now. And you would see that by looking at the daily change here. If you see my arrow, okay, here's the marker. I got the marker going. So if you look at these products here, this is my watch list basically. That wasn't a really good one. Let me do it again. So here, look at the ZN line. This is the 10-year bond, and this is the 30-year. 30-year will always be affected the most out of all these. Look how much the ZN moved. ZN is the 10-year. It moved 7 basis points. The ZB moved 14 basis points on that day. So the longer duration there is, 30 years, the more effect it will have on its price. And that's why, the idea is to like stay here. I mean, I trade, and ZB is the next most traded out of the 4 or 5 expirations in the treasuries. If I'm not wrong, maybe it's the 2 years or the 5 years before ZBs. But anyway, ZB is high up there. It has good liquidity. That's the point. It's a short credit spread, short put spread. Where am I? I'm here. I normally go to 17 deltas. I short my strike here. So this is the delta that I got there. Today is Saturday. So the market did not move on me. Or it hasn't moved yet. It stayed at 17. I did it just when the market was about to close. So before 12 p.m. Pacific. I shorted my strike on 111 and bought one strike down there below it at 110. I collected about $140 and something. The rationale here is, so trading part of my strategy is the bonds are really been beaten up. The rates are now have bottomed out, so the price is actually going up. And you can look at this at the chart here. It is going up, right? So I've shorted this at 110. Where did I short? 111? Yes, 111. So I've shorted this at 111, which is the bottom of this line, this T line, which I don't really use, to be honest. Whatever. It's just there for visuals. So I've shorted the bond here. It's a short put spread, meaning I'm long the price here. I'm long the bond, meaning the bond has to go up for me to make money. If it comes down, I will manage the trade, and when that happens, I will make another video on how the management is going. So the trade is basically stay at 17 deltas. I go between 17 and 18. I would never take this 23. It's too far up for me, too close to the money. The money is actually around 115, 116. So I go out 17. At 17 delta, short that strike, and then buy one right below it. That's because my account size limits me, or does not limit me, but allows me to do this kind of trade. You can go out and buy this strike too, 109, meaning your spread is now 2 strikes out, and you will put down more money to trade that because the risk is higher. Here, the risk is basically just 1 strike, the distance between 1 strike, and that's it. And that's how I trade. The P&L is 0 here because the market hasn't moved much, and I'll see what happens in the next few days. Let me know if you want to know anything about the Greeks. So I live within these Greeks here. Let me point these out to you. So this is my setup basically. These are all the columns I always use. So delta, gamma, theta, vega, open interest volume. These are my main. This is my bread and butter of the trading. So yeah, let me know if you have any question about why did I choose a delta of 17, what is my current theta, and what's everything else here, and I will be happy to respond. Like I said, it's a very start at the beginning of everything here, and happy to answer any questions, suggestions, whatever. Thank you very much for listening, for watching, for giving your time on this video. Thank you. Bye-bye.